North American stocks mostly in the red as investors ruminate over tech. Now, despite solid earnings, investors worry that companies are spending far too much on AI and won't see return on those investments. But let's see what else is troubling them. We welcome James Thorne, Chief Market Strategist at Wellington-Altus Private Wealth. Thanks for coming in.
Thanks for having me.
What do you think is weighing on investors that we are seeing this longer streak of red?
The market needed a pullback. When you think about the valuations of AI, they are stretched. But, if this is a generational CapEx theme, and I compare it to the railroad, then we're still in the early phases. So we're going to go into these periods of euphoria and fear. I think we just need to get used to it. I don't think this is anything out of the ordinary. The holy grail is artificial general intelligence. We need to build it out. We need to build the infrastructure out. We need energy. We need materials. So, the market, in April, it was the end of the world. Then we rallied to 6,900 on the S&P. Now we just had a nice, normal, healthy pullback. And people that don't understand what they own, maybe they're too levered, are selling and providing a great opportunity for long-term investors to position their portfolios.
Okay, so we knew about the valuations for some time. I'm just wondering, did you see a specific trigger to this fall off?
No, being in the business as long as I have, you can get a 5 to 8% correction for any reason whatsoever. And, it was a hedge fund said it was, Nvidia or Palantir were overvalued. Well, they have been. I mean, we could argue about Nvidia with a peg of about 0.55 not being that expensive. But right now, with the market so overextended, we needed a pullback. And so the way I put it is it's for whatever reason, so we're having it. So it's as normal, natural, and healthy. And what you have to ask yourself is, if we think about investing for 5 to 6 quarters in advance, what do you want your portfolio to look like? And I think there are some wonderful companies on sale right now that investors should start working their way into and start doing work on.
Meaning the companies that you're diversifying to, or some of the tech companies that you would pick up on now?
I think that the treasure hunt phase of this cycle is over and the winners have been identified. If you don't think Nvidia is the leading edge company in the world in terms of AI, then you need to do research on it. Micron, we're having a super cycle in memory. I mean, Seagate. So the winners, to me, have been identified. I think the real question comes later on in the back half of next year when the Fed starts to cut rates, Trump's supply side policies kick in, and we start to see a reacceleration of the U.S. economy. Do we want to go and diversify into more interest rate sensitive areas at that point in time?
Let's talk about the weakness that has been seen here and there in pockets of North America. I'm wondering, since we don't have new data from the U.S. quite just yet, do you see that underlying weakness carrying on to the end of the year, starting off the new year that way as well?
No, because, this is an unfortunate comment that Chair Powell made about flying blind or in a fog. The case freight index, which covers freight in the United States, it's at lows. I mean, Home Depot, terrible numbers, ADP. So if you look at the private numbers, there is enough data to suggest that the Fed is too tight. So I do think they're going to cut 25 in December. And I think also what they've done is, you over here, you've got QT or quantitative tightening, which is, or the Fed's balance sheet, which is the amount of reserves that are in the banking system to keep things going. I think they've taken too much water out of the bathtub and they've got to start replenishing. And that's what the president of the New York Fed said this week, that, they might be purchasing 25 billion additional securities next year. Add on to that the reinvestment of about 60 to 70 billion. So you're going to get a liquidity flush. And to me, bull markets end with a lack of liquidity, not valuation. So I'm expecting liquidity to come back into the market, and that'll benefit risk assets.
Let me ask you about the Home Depot earnings. It was a miss on a number of metrics. Do you see that as a signal, as others are for retailers?
I think most of the other retailers are correcting. People call it this K-shaped recovery where the high end's doing great and the low end's doing bad. Look, Secretary Bessent said it the best. The Fed has caused a recession in the housing market. The interest rate sensitive area of the economy, which did not cause the inflationary pressures, have been attacked by the Bank of Canada up here and the Fed. And it's just not right. They didn't cause the inflation. So when you think about it, what the Fed and the Bank of Canada needs to do is get rates down to basically give some energy into the real estate market. So no, I'm not surprised at all by what's happening with Home Depot.
All right, James, I do have to leave it there. I'm out of time. Thank you for your time. Appreciate you coming in.
Thank you.
James Thorne, Chief Market Strategist, Wellington-Altus Private Wealth.